Yeah, Niels, it's such a pleasure to have you. Great to meet you. Run me through your career background. I'd love to know more about you.
Sure. It really kind of started. Really depends how far back you want me to go. So, if we kind of chat through very briefly my, let's say, high schooling and this stuff. So I went to primary school first in Brunei in Southeast Asia. So my parents are in the oil business, and then we moved on to Australia. So I finished my high school in Australia. Started kind of going to university there. Had a few odd jobs here and there, working at the golf club, in the restaurants, these sort of things that people do when they finish school. And then decided I wanted to be a professional golfer, so I went on the PGA Tour for a year, playing professional golf. This was sort of to fill my gap year in between high school and university. As these things usually go, I kind of ran out of money at some point. So after a year, I decided to do something different and to kind of go and study something that could give me a bit more of a sustainable career path than playing professional golf. So I decided to move to Zurich in Switzerland to study quantitative finance. And pretty soon in the degree, I realized that this is not as exciting as I had anticipated it to be. So I kind of committed a lot of my time towards running a finance blog, like a little kind of newsletter thing called The Random Walk, which was kind of inspired by the title of the Malkiel book, talking about the how the short-term movements of stock prices kind of represent Brownian motion, and that there's a certain randomness in the movement of asset prices, at least in the short term. So I kind of thought that was a cool name. So I had this little website called The Random Walk where I used to just write my own research articles, and that sort of took on a little bit more of a quantitative element at some point where I was building very sort of at this point rudimentary models in terms of predicting asset prices, trying to find cross asset symmetries and correlations, and basically what now seems like kind of a simple concept, looking at plotting things like the S&P 500 versus gold on a logarithmic scale, which people don't really do much of, and then seeing what that relationship looks like, right? Usually people just look at a correlation as a number, but when you go a bit deeper and go looking at things like logarithmic relationships between two assets, you kind of see a very different picture. So started basically writing about things that I found interesting. So it really ranged from like, what's the future market cap of Apple? I mean, at the time, it was one of those companies where everyone was saying like, oh, this is going to be the biggest company of all time, and et cetera, et cetera. So there was a lot of talk about, how big can Apple get? So I wrote a little piece on that. Then there was another one that I did on specifically like Chinese demographics, like how does China's one-child policy impact the future growth of the economy, things like this. And then I kind of got onto writing about European bond markets, which was all about using a systematic approach to trade the bond markets essentially. So when the European Union was created, or specifically when the euro was introduced, there was quite a kind of fundamental error that was made in the sense that all of these countries are running under one monetary policy in the form of the euro, but they all have different fiscal policies. So each country kind of issues their own bonds, but they're running at the same interest rate on a currency level. So it really presented these quite interesting arbitrage opportunities between different European sovereign bonds that you could trade. So you saw this kind of quite clearly during the Greek debt crisis, where like Greek 10-year bonds were at like 15-20% yields. At the same time, German 10 years were at like 1% or 0.5%, right? So you had these huge delta between the yields of the European bonds. And my system essentially developed a way to trade the relationships between different European sovereign bonds against each other so that you go long and short certain parts of the yield curves of different countries at different times. So it was quite a sort of novel approach of doing it. And then this website newsletter I had, I just kind of started sending it out to my friends and family, and then it sort of turned into more of a broad reader base, let's say. I think at the maximum, I had about like 15,000 subscribers on it. And one of these happened to be a hedge fund in London who were looking at building a fund around European sovereign bond trading. So I was sitting in a finance lecture and I had my contact details on the newsletter. So my phone rang and the guy called me up and said, "Hey, I found your piece on your website. We'd like to have a chat to you and see if we can work together." So that was basically the beginning of how my finance career started. So they offered me a job straight out of uni to go and work on this fund, building a absolute return government bond fund strategy for a $300 billion hedge fund in London. So that was on, I mean, the guy called me on Thursday. I started in London on Monday. So basically packed my stuff, moved to London, kind of figured out how the city works. It was like the second or third time I'd ever been to London. And then started the new job on Monday. And from there, that was kind of a completely new learning experience, let's say, because you rang as this like 20-year-old kid into super competitive, high-powered hedge fund environment where people don't really believe in weekends and those sort of things. So it was definitely a way to start quickly at the deep end. So spent pretty much a year there building that fund. It was always kind of a 1 year project to get this strategy up and running for them. Following that, I went to a company called Henderson Global Investors. They're now called Janus Henderson. So they merged with Bill Gross's shop. So Bill Gross, the guy from PIMCO, they kind of call the Bond King. I don't know if he's still called that, but they called him the Bond King at some point. And there I was working on a equity long short tech fund. So something completely different, but also, applying quant principles to doing stock selection on the tech side. So that was kind of the very early stages of the career. And then that morphed into me moving back to Switzerland. I wanted to kind of work at a big bulge bracket, sort of big name firm. So I got a job working at UBS in the investment banking business. So there, I was on the trading floor for the next 7.5 years, basically running the hedge funds department. So I started there as a sort of junior trader, executing client orders for ultra high net worth clients for the bank. Then that turned into having direct relationships with the hedge fund managers, negotiating special placement terms that like certain funds that are closed to investors like the Renaissance Medallion Fund, for example, to get certain allocations to funds similar to the Medallion Fund. And then also turned into managing discretionary money for the bank internally. So we had certain amount of money that we could manage on a risk book, and that then also became part of the role. So really kind of exciting years. I mean, it's very intense also. There's the days tend to be quite long because you're trading European hours. Sometimes it goes into US hours as well. So it does tend to sort of drag on a little bit, but because of the intensity of the environment, I think you really do learn quite a lot very quickly. And yeah, that was my role until the end of 2018, where I decided to basically spin out of the bank and start my own little firm focused on quant research. So building quantitative trading models to find strategies, particularly in the FX and index future options markets. So a friend of mine and myself, we got together and started building models to have systematic trading strategies, which can be deployed without any manual intervention. So the whole idea was, I think both of us were kind of a little bit scarred from having spent so much time in front of a computer screen that we wanted to spend less time in front of a computer screen. And, and the way to do that for us seemed to be to build a system that does the same thing we did, but without us looking at the computer. So that was always kind of the goal. And we developed a number of systems over the years that kind of work pretty consistently. And it is a lot of trial and error. I think these are always things where you build something, you got to test it. Then after 6 months, something happens that you didn't expect to happen, and then you lose all your money and you got to basically start again. So we had quite a few of those. events happening as well. So there was a lot of educational money that was spent on the way, and that's at least how we look at it. Like you learn from every loss that you make doing this and refine the system more and more. That kind of each time where you get burnt, it does get a little bit better. So we've been working on that since the end of 2008, which what it essentially does is to improve the properties of plastic materials, like to improve recyclability, malleability of the materials, stuff like this. So adhesion properties. So this company is really doing quite well. So that's just a venture deal that I did as a seed investor, and then following the exit from UBS, I actually moved back to London again and got involved with a real estate fund here. So we were basically deploying capital into German property developers, so providing them with the necessary capital to go and get bank financing to do residential development projects in Germany. So we raised approximately 250 million euros like that from a multifamily office, and then deployed the strategy for around about 3 years. The market sort of changed a little bit following the Ukraine situation, because something that was not known to me was that Ukraine is actually quite an important manufacturer of a lot of very random bits and pieces in the building industry. So stuff like door handles and the locking mechanisms for certain pieces of a door, uh, a lot of that stuff comes from Ukraine. So there seems to be quite a big steel industry in Ukraine, which I think a lot of people in the construction business might have underestimated at that time. So um, as soon as the Ukraine situation kind of started, we had a lot of supply issues getting certain spare parts for the construction site. We ordered a bunch of locks for the kitchen doors and whatever else, stuff like this. And then all of a sudden they had like a 9 month delivery window. So at some point, then that also, became inflation. We essentially relatively early on in that cycle decided to stop deploying capital to try and recover our money back. And we did that successfully prior to the worst bit of the market kind of being impacted. So in that sense, I think that was probably the right decision at the time. And yeah, since then, that's been my focus has been mainly on the quant systems and building out, looking for exciting opportunities in other verticals as well. So it's really been a bit of a journey if you think from the beginning of writing a very, very average looking blog on a very cheap laptop sitting in a finance lecture to the things that happened after that. But I think there's always new opportunities that come up. Like right now, I'm working on a new strategy, which is very kind of completely different to anything I was doing before. It's about the secondary market trading of American life insurance policies. So I'm looking at building a possible strategy around that. So I think you just kind of have to keep your eyes open and see what opportunities are out there. It's a little bit like what we touched on prior to this discussion on the crypto market, how that's changed over the years, and where you've really seen a huge shift in also utility of certain things, like how you can use Bitcoin. Like in Switzerland, for example, you can pay your tax bill using crypto, right? So if you can go to the state authorities and send them your Bitcoin to pay your tax bill. So that's quite a kind of unique utility for it, I think. And I think there's a lot more broad scale adoption at this point. So yeah, to me, it's kind of become more of a case of always being open to new opportunities, looking at what's moving in the market, and I think that's really important as well, to stay flexible enough that you don't end up pigeonholing yourself and saying I only do this and nothing left and right of that, because then you inevitably end up missing things like you and I both did in terms of, early adoption of crypto, which we were, to be honest, both very well positioned to potentially have taken advantage of. But yeah, I guess it's always a bit of a learning experience and a journey that develops over time as well.
Niels, that's amazing. Thank you so much for sharing your background. I think one of my favorite pieces of your story was how you got your first job, that the hedge fund called you because you were doing something that you were kind of passionate about and putting it online. That's definitely a lesson for me in my, in my attempts now to align my professional life with the things that I'm personally passionate about, and the courage that's kind of required to do that and then kind of like do it publicly as well. So that's awesome. I also loved how your story was so multidimensional. It seems like you really had, you went from being like a public and markets investor to doing things like investing in real estate developments, which is something that I've done in the past. And it's hard asset investing is very different from trading, basically. So it's cool that you had that kind of multidimensionality in your professional experiences. I also love the fact that your ride was like a roller coaster. You said that you lost all your money on educational purposes, basically, on several occasions. So I think that also speaks to the courage of trying something new, and then going through a learning curve. So kudos to you for that. Um, for the listeners, I would like to ask you to walk us through a day in the life of a trader, at one of these kind of intense trading environments that you spend time in, where these guys don't really believe in weekends. It would be great to hear, what your morning looks like, time you wake up, what time you get to work, whether you have time for the gym, what you experience in the office, and what your weekends are like, whether you have time for dating or
Mhm.
personal development and stuff like that.
Sure. So I think it really that there's kind of a couple of different sides to the answer. So it really depends on if your role is like a market driven trading role, then that has kind of fairly rigid boundaries as to timing and what your day can look like. So let's say typically especially if you're working in the UK, you have the disadvantage of being an hour behind, depending on which direction you look at it as. But the guys in the UK are generally an hour behind the Europeans, right? So if you're here in London, you would say you absolutely have to be in the office by about 6:45 or 7 a.m. 7 a.m. tends to be the time where you have the kind of morning calls with your clients. So you would every morning have a regular call where all of the clients can dial in. It's like a conference call every morning where you basically update the clients on what happened overnight. So that's kind of part of the equation as well, that you have to be up to speed on what happened during the night when you were supposed to be sleeping to be able to tell the clients in the morning. So you would have to, kind of get up sufficiently early enough to catch up on all that reading. So you could probably safely say, waking up at 5 is probably where you're at. Between 6 and 7, you'd want to be absorbing as much of the overnight data as you can. So any sort of news releases from the Asian market hours, the stuff that might have happened late in the US, which will be, sort of 10:30, 11 o'clock London time or midnight around here. Uh, and so basically, by the time 7 o'clock kicks around, you have to be very well versed on everything that's happened in the whole world in the last sort of 9 hours that you weren't working, or 8 hours that you might have not been in the office. So 7 o'clock typically kicks off with a morning call. You explain to people what the significance is of the latest monetary policy meeting minutes in Japan, or what the alien central government, as a central bank, has decided to do with their interest rates, or you know what's now going to happen with the military uprising in Myanmar, or whatever else happened during the night, right? So it's pretty comprehensive, this stuff you have to learn. So there's a lot of like general knowledge that you build up as well. Given a lot of it is also probably a little bit headline driven, where you might not be an absolute expert on every topic, but you'll know a little bit about everything that's happening everywhere. So um, it's enough to go into a bar and have a conversation about it, let's say. But if someone asks you, you know, the exact details of everything, you might get a little bit lost if you're, depends on how many topics you're covering. But so usually 7 o'clock starts like that. You've got kind of a 30-minute call with your biggest clients who, well, to be honest, anyone from the direct access clients can dial in. So you tend to have, you know, your ultra high net worth clients who are there, who want their kind of morning digest of what's going to happen in the markets and to have some sort of direction on what's coming up. So you generally start with the overview of the previous night, then you move on to projections for the day ahead. So you kind of give people a heads up as to what's going to be happening in markets in different hours. You know, if there's a central bank meeting, if there's non-farm payrolls coming out, if you know whatever major news releases are on the docket, and then yeah, I mean, if you run out of time and don't have anything else useful to say, maybe throw some jokes in there to put everyone in a good mood at 7 o'clock in the morning. That always kind of tends to work. Um, and then yeah, as soon as the stock market opens, you sort of kick off. I mean, it tends to be around 8:30 European time, so from 7:30 UK, you know, the first derivatives markets start moving. Obviously, the OTC stuff always kind of moves anyway, and then you're pretty much flat out until the afternoon when stock markets close if you're working European hours. And if you're unfortunate enough to also have some US exposure, then you have the privilege of doing that same thing until around about 10 p.m. UK time. So um, usually these teams are kind of split up between market hours. So you would have guys who just focus on Europe and then they get to go home at some point, and then you have a US team who takes over the American trading hours. But there's certain banks where people will trade both markets, which can be quite tough. Um, I suppose when you're sitting there and you're kind of in the zone and you're in the groove, you may as well just kind of carry on for a few more hours. But the days do tend to get quite long. So assuming you're doing just the European hours, you're kind of, I would say 7 to 7 is your sort of rough schedule. Let's say maybe 7 to 6 if there's not much kind of on the admin side to do. And then the nice thing is that after that, you're pretty much done for the day. As a trader, at least, there tends to not be a lot of admin overhang at the end of the day. So it is sort of limited to the hours that the market is open, which is quite nice. That sort of differs a bit from other investment banking jobs. Like if you're in the M&A team or something, you know, you can be there reformatting the
The
text
deck.
box on the PowerPoint all night
Yeah.
long and moving stuff from left to right and and shrinkos and stuff. So you can be, and then at 2 a.m. the MD will send you some comments saying that the bullet point was in the wrong spot or something. So as a trader, you don't have that. So you're not really what we like to call a slide slave, right? So there's not much of that happening. There's a few bits and pieces with like Excel and whatever, and sometimes you have to, go and present something to a client, but you tend to kind of outsource that to someone who's better at building slides, like the guy who's reformatting logos all night. So you can kind of say it's a 7 to 7 job, and then on either side of that, you're pretty much free to do what you want. So I would say generally most of the guys live a fairly um, healthy lifestyle. I mean, that probably contradicts what most people think. They think it's all about, partying and spending lots of money at the bars and stuff. But most of the guys actually tend to live quite a healthy existence. I think because the job during the day is very intense. It's very stressful. So most people kind of look for, and most people are quite into that stuff. I think it's also a function of you're sitting down the whole day. So because you're kind of glued to the desk, it's a fairly intense environment. At some point, it's quite nice to, have some physical activity. I think generally humans are probably not built to be sitting strapped to a desk all day, shouting at clients, or maybe ideally not shouting at clients, but in a kind of very stressful environment. So yeah, they tend to be very, very healthy bunch of guys. So it's very different to what you would see on like Wolf of Wall Street. I think those days are probably gone. I mean, the misconceptions that there's lots of drug abuse and white powder flying around on the trading floors is very much a myth at this point. There's, at least in the environment where I was working, in UBS, there was very rigorous rules on that stuff. There was no tolerance with anything towards those sort of, substance abuse things. If you turned up to the office with a hangover, they send you home, those sort of things. So that's there's a big kind of delta there between, what people think happens and what actually happens. So there's definitely no like lines of cocaine being snorted from the top of a Bloomberg terminal or that. So at least I've never seen it. So if that
Niels,
was happening, it was very undercover and no one ever
I'm,
spoke about it. So
Niels, I'm sorry to interrupt you, but I'm just a bit cognizant of time. We have about 7 minutes left, and I still want to have time to cover
sure.
exit opportunities. So you mentioned that you went from, the public markets trading to effectively, private equity in the real estate space, right? So it'd be interesting to hear what your views are on exit opportunities, because for me, these are very different skill sets, private equity and public markets.
Sure.
So it's interesting that what kind of connection you see between the two, and then what other opportunities you see for people that are going to the public side of things. I also want you to touch on what you see as the current trends in global markets, like the role that artificial intelligence is playing in trading, machine learning is playing in trading, and to close, if you can give some advice to young guys and girls that are looking for a way to get into a hedge fund or into some sort of trading desk. Any advice you have on that front would
Mhm.
be great as well.
Okay. So look, I think so to go back to the first question on the exit opportunities, I think it, it tends to be that people start on what they call the sell side, which is like a classic investment bank. Any of the big names, JP Morgan, UBS, Goldman Sachs, those kind of names. They tend to be a really good place to learn skills and to really kind of develop as a trader or as an investor as well. You have very kind of broad exposure to a wide range of topics in those banks. You have the opportunity to learn a lot of different things. Like I could also go and spend a couple of weeks with different teams, so I did a bit of a stint in like private banking as well. Then I went to see how does like the back office operations work. So you kind of have a really broad spectrum of skill sets when you come out of there. And they, I don't want to say like the big banks make you necessarily better at anything, but they do teach you how to work, let's say. So you learn to, being able to apply yourself intensely for 12 hours straight. Like it's those kind of tools that I think it gives you. So I think the exit opportunities that most people would want to be looking at is to transition from working at a big bank to working at a smaller, bit more of a boutique place. Most people want to try and end up at a hedge fund in some capacity because on the one hand, you do have very attractive compensation structures there, but you also have a bit more freedom to bring in more esoteric strategies. So let's say if you're working at a big bank, you're kind of quite restricted in what you can do. Whereas at a hedge fund, it's more about what does the guy who owns the hedge fund want to do, right? If he says, yeah, Alex is a smart dude, let's let him run with the strategy he's come up with, then they'll let you try it. They'll usually help you to refine it a bit. And if it works, you get paid a lot of money. If it doesn't work, you probably get fired after 6 months. But at least you tried, right? So I think that's kind of one direction that a lot of people go and they want to go to a hedge fund. Obviously, there's a limited number of spaces available at those places. They tend to be kind of quite small shops as well. What has recently become really popular is going to like a private credit fund. So private credit is sort of the new growing asset class. I mean, I think there's a lot of positive spin on it at the moment. It seems to be quite popular, especially when rates go up. Private lending seems to be that industry that benefits from that. So it always kind of comes in waves, right? It's in between. Everyone wants to go to private equity, then they want to go to private credit, then hedge funds are all the rage, and then after that, everyone wants to go back to Goldman Sachs, right? So it's a bit of like a circus that kind of goes around town. But I think generally you're probably your best bet is to try and if you're working at a big bank to build good relationships with the clients that you operate with. Those clients tend to be very wealthy. They will tend to know people at hedge funds because they're also invested in those hedge funds and they can usually help you to, at least get a foot through the door or get into the interview process. So that's normally the hardest bit is actually getting through the door at these places to have an opportunity to tell your story. So I think generally if you're passionate about what you do, you're good at what you do, your clients will notice and they will either, what also happens sometimes is that clients will come and recruit you and put you in one of their operating businesses, right? These people tend to have, their own companies or something. And it's not super rare that, a private banking guy or a trader will be recruited to go and work in one of the companies that is owned by their clients as well. So that's another avenue that people have. If they want to kind of go completely a different direction, then maybe one of your big clients owns a steel manufacturing business somewhere and they're looking for a CFO, things like that do come up as well. So that's kind of what I would be looking at in terms of exit opportunities. Then your next question was on the trends in the market, right? Trends in the industry
Yeah,
and AI, if
and
I remember correctly.
machine
So
learning as well.
yeah. So what I noticed, this is actually honestly part of the reason why I left UBS at the time, was I was noticing that for each trader that quit, we were hiring one programmer. And the programmer was there to replicate the work that the trader was doing. So
Right.
we were basically slowly being replaced. Like the human element of trading is kind of on the way out, I think. If you notice, the if you're going to analyze the flows in the stock market, you'll notice that on the S&P 500, approximately 98% of the flow is what they call STP flow, which is straight through processing. Like there's no human intervention anywhere. This is all just computers firing at each other. So I think the role of a trader is really being diminished. So it's not what it used to be where, you can really add a lot of value by having relationships with other prop desks and stuff like this. This still exists, but in a much smaller capacity. So the majority of trading now is done by algorithmic systems. Even at UBS, we had huge amount of infrastructure on the algorithmic side, where even for order execution, let's say you put in a big order to buy, I don't know, $1 billion of JP Morgan stock. If you click that order through on the order system, then it goes into the order algorithm, which basically will hunt through the market. It does that all automatically in the space of like milliseconds, right? So these computer systems are immensely powerful, and that's definitely something that's changing the way that investment banking and trading works. Um, I think if I was to go back and kind of do it again, I would go at it more from a technology perspective. I would probably go more looking at computer science, machine learning, having some sort of technical background or degree in those spaces, because that to me has a lot more longevity than having those skills as a trader that are being kind of slowly becoming obsolete, let's say. So I noticed as well that the guys now who are making the most money, they're programmers. They're the guys building the systems. They're the ones working on the machine learning engines, on the AI engines that these hedge funds use. There's I mean, the most successful hedge fund in the world is a great example, right? Renaissance Technologies. They are purely physicists, mathematicians, chemists, they're all just scientists. I don't think there's a single guy there who actually studied economics, but these guys are doing like the Medallion Fund, I think, does 66% annualized returns since like 1982, right? These guys are out of this world. And they're all guys who have, computer science backgrounds, mathematics, engineering, those sort of things. So I think the way that the finance world is evolving, it's looking more towards those kind of skill sets. If you go on any hedge fund website now on the career section, 80% of the jobs are for C++ developers, Python developers, quant traders, quant system developers. It's all around the quant systems, right? So the vast majority of the jobs at a fund are to do with systematic trading. So everyone is pivoting towards that. It is also it's the way to make the most money. The most successful strategies are quant strategies, and all the funds are pivoting towards that. There's really no exception to that rule either. I mean, if you look at Point 72, which is a very big hedge fund, or Marshall Wace or Brevin Howard or any of the big guys, they're all very heavily focusing on um, computer science guys, data science graduates, guys who can build software, who can feed these AI systems and these machine learning systems. That's really where the emphasis is going.
Yeah, that's super interesting. I had a buddy at Citadel. I'm not really versed. I'm not a trader. I don't have any experience in this business. But I came away from a conversation with my buddy at Citadel with the understanding that the guys that are making the good trades are the guys that have the best infrastructure that facilitates information flow milliseconds faster than their competitors. So it's like it really comes down to like the kinds of cables that they're using that are communicating information from the point of decision to the point at which a trade is actually executed. So very interesting.
Completely, yeah. Yeah.
And
I mean,
just
there's also the amount of money that's being paid is also enormous. I mean, just this is a bit of a tangent, but there's a company in London, they do basically like big data pounds a month. That's just an internship, right? So these guys are making more than the dudes at Goldman Sachs or more than the hedge fund guys just doing data analytics. So there's incredible opportunities out there in that space.
what about advice to students on recruitment?
So I think if you're, look, I think generally if you primarily have to do the stuff that you enjoy, right? If you don't really enjoy building computer systems or programming or software development, then I don't think it's necessarily a good idea to like force yourself to do something that you're not enjoying, because if you don't enjoy it, you're not going to be very good at it, essentially. So it's let's say it's very hard to be good at something that you hate doing, right? Because then you're not going to put in the necessary time. You can't put in the kind of time commitment that it needs. And then you're never going to be good at it, because there's always going to be someone who enjoys doing it, who's going to be better at it than you are, and they'll get the jobs that you want, right? So I think right at the beginning, you got to identify what part of the job do you enjoy? Do you just enjoy the money? Do you enjoy dealing with people? Do you want to, do you like the infrastructure side of it? And then kind of go from there. If you're more of a kind of dealing with people sort of guy, then I think there's also really great opportunities in working at a hedge fund in business development, right? There's teams of people at hedge funds who work on finding new managers. If it's like a multi-strat fund or like a multi-manager fund, there's biz dev people who go and try and recruit new managers to come and work in this fund. So they also have a really really cool career path, and they make lots of money as well. Then you can say if you're more on the quant side, then I would be looking at kind of more the programming style roles where you're really focused on building these systems. There you have a huge amount of jobs available. Your skills are also very in demand, so you're never going to really have a shortage of jobs. Um, but and then there's other people who really love the kind of deal making element of it, where maybe mergers and acquisitions is still a good place to be. It's a bit of a different animal now these days, I think, because even AI is kind of creeping into the M&A departments. So UBS, for example, have just released a AI tool which lets you analyze like 300,000 companies in 2 seconds, and it tells you, or it makes a prediction as to which companies in this universe of companies are most likely to merge with each other and what that would look like. So it's kind of a whole investment banking intern department on crack, basically. So there is kind of a lot of expansion or like development in that space as well. So I'm not super convinced about the longevity of the classic M&A analyst job anymore either. I think if you look at how powerful like ChatGPT and these kind of tools are, which you could argue are still in a very sort of rudimentary phase of their development, like that's going to accelerate massively over the next few years. I think anything that's sort of these repetitive tasks, which involves producing pitch decks and updating numbers and whatever else, these are all things that are going to be automated through the use of machine learning, AI, those sort of things. Um, and which is where, kind of leads back to having a focus on computer science and having the knowledge of how these AI systems work, because that's what all companies are looking for. Like every company needs this. Everyone's looking at the space. And if you're the guy who knows how to, make the brain tick, then you're a very important person in that company. So I think that's definitely what I would be focusing on now from a recruitment side. I mean, I'm even looking at potentially doing some more further education in the programming space, to have more specific skills in Python programming and that stuff that I never really did any formal education in. I did it as a bit of a learning by doing thing in the bank. So that's something I'm even considering now, just to keep training and keep educating yourself to keep up with the trends, because what you don't want to be is the washed up ex trader who doesn't know anything else other than, the old fashioned method of trading stocks and stuff like that on the phone, right? Because that will at some point be a thing of the past, and you got to keep moving with the times and keeping up with the current trends.
Niels, thank you for your wisdom and story, and for sharing all of these insights with Canary Wharf. And it's been a pleasure to have you on board.
Cool. Thanks so much, Alex, and look forward to speaking to you again soon.